when do you think like the rates on the long end become an issue for banks? Because I know that we've always talked about the 5% level being a real issue. I mean, we're at 10 years for 55, 2 years for, the 2 years staying anchored, to be honest, for the most part. Like that, maybe that's it. Like, as long as the front of the curve stays anchored, truth is the back end doesn't really even have that much paper. It's one of those things that equity guys like to talk about, and maybe for the mortgage market, but like it's real bond market is 5 years and under, and really.
Yeah, I mean the short end, banks look at the spread from 3 to 6 month out to the 5 year. That's the spread that affects banks the most. The belly of the curve is important in terms of where it trades for a couple reasons. Obviously, the 2 year anticipates or pushes the Fed into certain action, so the 2 year is important to watch. And then a lot of your consumer loans, like auto loans or adjustable rate mortgages, are done in the belly of the curve. Your C&I lending is all done off of SOFR, so that's overnight. But higher rates, generally are going to create some pressure and competition for deposits. And banks have been very aggressive in lowering their deposits. I was just talking with a client yesterday about Wells Fargo. Their average cost of deposits is 1.9%. The average for the industry in the first quarter was 2.11%. And so SOFR is 360, 370, something like that. So if we have higher rates because of higher oil prices, there's going to be a real liquidity drain on bank deposits as yield-seeking investors move their money out of banks into other vehicles. That's going to put some pressure on spread. And right now, as banks will say, the KRE, which is the regional bank index, has been acting better than, the capital markets related bank. But the KRE could come under pressure if we get some, competition for deposit, because that's their core cost of goods sold, if you will, in a spread lending business. So I'm watching that carefully, and I'll tell you, Ben, I'm watching that long end. We need to get it back above 518, 520 on the 30 year for, I think, a breakout. And so we're pushing 505 these days. On the 10 year, I think we have to get back above 470 for a breakout. I mean,
you also got to remember that it's not just the level, right? The rate of change is what really matters. And so if you think about March, we had a VAR shock blow up, right? Yours truly got totally smoked on his Z7s as well. So I didn't thought that the phrase, but there was a lot of guys who were all along the short end of the curve that got blown out. But this has been pretty orderly, right? It's kind of drifted up a little bit, but it's not really moving with it. Because if you look at the MOVE index, it's at 70. It's not at the low lows, but in March it was 118. So that's been pretty supportive in general. So I just think with banks, maybe vol picks up, rates are up here. Maybe that contributes to them being weak, on a go forward off these highs. I don't know. What do you think about that?
I'm going back to the yield curve and just thinking about it. The peak steep in this calendar year was around 70 basis points in February. That's between 2s and 10. And then we had, a flattener trade, but a bear flattener trade, from February into roughly June, I'd say. And now we're going back to a bear steepener. And the bottom line is they're both bear trades, whether it's a flattener or a steepener, they're bear trades. And that's not good for banks. And banks are at their historical high in terms of relative multiples. Banks trade at 50 to 60% of the market multiple, and they largely trade there because, their balance sheets are viewed as black boxes. No one really knows, and they can't value them. So they discount the valuation. So if we get into a higher rate environment that starts to stress, corporate lending, then that discount's going to come down from 60% back to 50%. And we're at the high end of that range right now. So I can't buy bank stocks here. I just can't. I'm sorry.
No, I'm with you completely. I'm 100% with you. We talked about that. Let's see where this is at.
Ben, we're in the minority. I'll tell you, every strategist that comes on Bubble Vision is saying, and, you got to buy financials. All the bank analysts are, falling over themselves, bullish about financials. And it's largely because of three things. One, deregulation is going to lead to higher valuations, and we can talk about whether that's valid or not. Two is the capital market cycle has no end in sight. And three, credit is very benign. So those are the three bull arguments. One of the things I may have underestimated in turning bearish here recently is, the flows coming out of tech into financials have been substantial.
Yeah, I think that's probably partially some of it. You've seen, honestly, the picks and shovels guys, I was looking at the board, it's down, they're down a lot. They've been derated pretty good here. My CoreWeave short's down almost 50 or 60 off the all-time, or it's 52-week high. But, a lot of the stuff's down 15, 20 to 30%. The AI CapEx beneficiaries and hyperscalers and, so that money been going. Healthcare, our boy David Maris' sector's been good. Biotech's been really good. Materials has no positioning there. Consumer cycle, we talked about that, Charlie, with Home Depot in May, and it was left for dead. No one wanted Home Depot, and it's had a nice move here. So I think that's right. I think there is some reallocation. I'm always skeptical of June though, because you get that year-end Russell reconstitution, rebalance, whatever you want to call it. So let's see as we get going here. This is around the time where the lowest part of the vol suppression of the year is over. Usually it's like June 26th, 27th till about July 6th, 7th, maybe the 8th. Remember July 24, we had, highs. And then one day, NASDAQ was down 3% and the game was on, finishing with the Nikkei down 10% in one evening on August 5th.